Clock. Recording's in progress. Thank you. Should we close the bowl?
Close the bowl.
Close the bowl. Okay. No one gets it. We should have something that says the bowl is closed. Gina, you were here, right?
Yeah, she was.
All right, we'll give you a break. There's one exception. Do you have a business card, Gina?
No, I already won twice. I don't want to go.
Oh my God, she won twice already.
Look at how kind she is.
You can donate the cards to somebody else, Gina, if you win again. You don't have to keep them. You'll take some. Are you
Like a race, who's gonna get to go?
Are you buying drinks too, Gina? Because I'll go.
He'll start snoring about 5 minutes in now.
Yeah. It depends what kind of a movie it is. I can fall asleep during a movie easily.
What Sarah is that online? We have lots of Sarahs.
Do we have lots of Sarahs? Okay,
Yeah.
great. All right, well, today's discussion actually is about property tax exemptions. And we're going to talk specifically about Prop 19. And that's been memorialized under Senate Bill 539 for those of you interested in the technical aspects of that. So typically when a property sells, it's subject to a change it's subject to reassessment, but there are exemptions. So Prop 19, for example, is going to give us an opportunity for certain exemptions. And California is aging. There are those such as myself that are in excess of age 55. And I moved and I can take advantage of that. And you may have many clients, as a matter of fact, that are probably in excess of that age. So you might be able to help them and guide them in regards to buying their replacement property and transferring the current assessed value to the replacement property. There's always some exceptions, by the way. So before Prop 60 and Prop 90 were in place. Prop 60 allowed in transfers within the same county. Prop 90 intra-county, but there were only 9 counties, I believe, that participated. So Prop 19 supersedes Props 60 and Prop 90. So if anyone questions you about that, unless they sold a property going back to April 2021, Prop 19 is going to apply. And then there's new rules on intergenerational transfers. Before, grandparents or parents could transfer a substantial amount of property to their descendants, and they wouldn't have a reassessment, but now the rules have changed. And that's limited to $1 million over the original purchase price. So I'll give you an example. Let's assume grandparents bought a house for $3 million. It's now worth $10 million. In that example, you would get $1 million reduction. Okay, we're talking about the original purchase price, the original assessed value, not today's Prop 13 assessed value. So it's a huge difference. And it's a disservice, unfortunately, because many people, they get these properties, they can't afford to pay the property taxes anymore. And then in regards to Prop 19, you must be at least 55 years of age or older. You can buy a property anywhere in the state of California to transfer your assessed value. And you must do so within 2 years of the sale of your existing primary residence. So it could be 2 years before or 2 years after the sale. So it's a 4-year time frame, actually. And you can use Prop 19 up to 3 times. If you've used Prop 60 or Prop 90, that does not count as one of your opportunities for those 3 transfers. And then must the sale of the original property and the replacement property happen at the same time? No, it's not a requirement. You can actually buy the replacement property within 2 years prior to the sale of the existing primary residence, or you can buy the replacement property within 2 years following the sale of your primary residence. So today's 2024, maybe I bought a home in 2023 that I intend to make my primary residence and I want to transfer my assessed value. That property can qualify. Also, if I buy a property in 2025, that property can also qualify. So once again, 2 years before the sale of my primary residence, 2 years after the sale of my primary residence. That's the time frame. What about renting out your existing primary residence? What if I buy a replacement property? Can I just simply sell my primary residence, rent it out, not sell it? No. The requirement is that you both must acquire and sell those properties. So the original property must be sold before you can transfer the assessed value to the replacement property. So what about if I want to give my property to my son? Well, if the property is by gift or device, meaning through inheritance, that's not considered a sale. A sale is something for consideration. So if I give my property to my son, he's not entitled to the benefits of Prop 19. He'd actually have to buy it in an arm's length transaction to be able to transfer the basis to him to obtain that lower assessed value. So the rules are the property must be subject to a change of ownership and something of value must occur. So it's got to be an actual bona fide sale. Any questions about that?
I have another question.
Sure.
What if somebody has sold a property in another state but then purchases in California? Would it?
There's no benefit because it's within California
Has to be
only.
within
It
California.
has to be within California, as a matter of fact, yeah.
You
Yeah.
can sell the property for whatever, right? Like, if I wanted to sell it to my kid and I say, whatever, give me $100,000 and the value is way more, it doesn't matter, right?
Well, you're going to be reporting that sale, and is that going to be contested by the assessor when you're applying for the exemption? So I think the possibility exists that it would be contested and you may lose the benefit, as a matter of fact. Because they're going to look at the value of the property, and that's very generous of you. Yeah, I'd be happy to be one of your children. A margin of error? I think it's got to be reasonable, whatever that margin of error translates into, a few percent. If you have an idea what the value of the property is, you can bet that the assessor is going to know what the value of the property is. And when the surrounding properties, and Irvine's a good example, it's too easy to appraise homes here.
Yeah.
So that's going to be the dilemma.
The issue you run into, because I had one where buying a market, home under market, so let's just say it was worth $1 million and you bought it for $850. The assessor will look at it and they may assess it at 9 and raise you more than the actual purchase price. You can dispute it, but if you dispute it, it allows them to mark it up to $1 million. So you risk when you dispute it, that it gives them the opportunity to raise the value from where it already is. So if they give you a good enough value, if it was $850, you bought it, they appraised it at 9 and it's worth $1 million, you don't want to dispute it. You have the opportunity to, but very likely if you do, it could cost you and they could raise it. Because I had that ran into that years ago.
There's no going back to them and say, I'll just take your first.
No, that's the thing. If you're gonna challenge it, you risk it going the other way.
If it's a tax grab, I think you're going to lose.
Yeah. So you want to
Question
be
from you,
careful about doing that.
Well, so in a case that is just cash transaction, there is no appraisal that's going to be in place, is that the city appraiser is going to do it? Or-
No, it's the assessor.
Assessor.
The assessor.
assessor.
It's always going to be the county assessor that's going to be appraising
Right.
the value. Or
As
making
long
a
as if it's
determination.
higher than the previous, assessment, doesn't matter.
Doesn't matter.
Okay.
If you get it just so much under market, they could
It's too late.
they would reassess it.
We intentionally talked about you.
This is pretty close to being on time, I have to say.
Well, next week it's available. They made the rules up. We took a vote here. We said if anybody comes in after 10 o'clock, and we allow them to insert their card. So anyone that wants to allow someone who came in after 10 o'clock, should we allow them to insert their card? Yes or no?
No,
No. An exemption.
we are gonna say yes, but the exception was you.
So we'll think about it. Yeah. So if the replacement dwelling is purchased or constructed before the original property is sold, can the base year value be transferred at the time of the purchase or construction? No. So it can't be transferred until the original property is sold. So you must sell that original property to transfer the base year value. And remember, you've got that 2-year window. So what is available for the reassessment exemptions? Well, single family homes, condos, co-ops, for example. What about ADUs? or junior ADUs. Well, if it's not a separate alienable unit, then yes, it is exempt, it's available for the exemption. It's considered a single family property. So if you were to subdivide a property in which you had an ADU on it, then you would lose the exemption, as a matter of fact. So those people with ADUs on them, it's just deemed to be a single family home. And it doesn't matter if they're occupying the original residence or the ADU, as a matter of fact. So they can buy a property with an ADU on it, as long as they occupy one of them, or they can sell a property with an ADU, just as long as they're occupying one of their properties on that land. Mobile homes also, if a mobile home is subject to property tax, the exemption is available to them, right? Sometimes mobile homes just have personal property tax and exemption would not be available. In a mobile home, if there's real property tax, even if they don't own the land, the exemption could be available for them. Then how about partnerships, associations, corporations, or other legal entities? Can they transfer their base year value? No, it's only available to individuals or an individual's revocable trust, for example. It's available to that only. So if it's in an LLC, the availability is not there for the exemption. What about, must the taxpayer actually live in the original property or the replacement property in order to be eligible for the exemption? Well, yes, the person must own and occupy the original property at the time of sale or within 2 years of the acquisition of the replacement property. And you must own and occupy the replacement property. So occupancy and ownership are a requirement to make sure that the assessment or the exemption, excuse me, is available to you.
Is there a threshold on the occupancy time? I mean, if you only spent 3 months of the year there, would that?
Well, it's whatever you claim as your primary residence. Usually what the assessors, there's two things. You must be available for the homeowner's exemption. So you should consider, to protect yourself, filing for the homeowner's exemption, the $7,000 exemption, or at least be eligible for the homeowner's exemption. But obviously the best way to protect yourself is to file for the homeowner's exemption.
And you said within 2 years you have to.
Yes.
So.
And within that 2 years, you should file the homeowner's exemption. That's going to be evidence that
the
you're
first 2
claiming.
years you can do what? Can't rent it out.
You can, if I sold my original residence 2 years ago, that's okay. What if I bought another property in the meantime and made that my primary residence for 6 months or 8 months? I don't have to transfer or use the exemption for that interim property. That's at my discretion if I wish to use the exemption for a replacement property. You just have a 2-year time from the time you last owned and occupied the original property to the time you own and occupy the replacement property. It's going to happen within a 2-year time frame. Hi, Gina.
So like, if you have one property and then you sell it and you go into a larger property, is it the assessor's office that you contact to make sure that the property taxes are just correct?
So 2 things, the homeowner's exemption, that's with the assessor's office, and then there's you would contact, there's a form with the Board of Equalization that you would submit the request for the exemption to. So 2-step process theoretically. You should file for the exemption, the $7,000 homeowner exemption. If you don't, you should be eligible for it. But then also you'll submit, I don't have the form number on the top of my head, to the Board of Equalization for the exemption, or to apply for the exemption to transfer the assessed value from the original property to the replacement property. I see you have this question on your face, Gina. Oh, no, no. Okay. Okay.
Early in the morning.
I know something's gonna come up.
2 cups of coffee.
Yeah. You're wound up, okay. Let's see. Can I have a co-owner on title and still qualify to transfer my base year value under Proposition 19? Yeah, you can. There's no requirement that the person who is age 55 years or older must be the sole owner of the property. The requirement is at the time of sale of the original property, the person who's going to claim the exemption must be 55 years of age or older. I can buy a property at age 54. And once I turn 55, sell it. I'm now eligible to apply for the exemption for my replacement property.
What happens if those two co-owners end up buying two different houses? After the
Depends.
sale?
That's a good question. So if it's a married couple and they're deciding they're getting a divorce and they're going to buy separate residences, only one is entitled, and they have to make a decision as to who's going to be entitled to make that election for the exemption.
What if it's a father and son?
And they're living in one single family home? Well, my guess is, well, are they both over 55?
No.
All right, so only the person who's 55 years of age at the time of sale is entitled to apply for the exemption.
But they get the full.
They get the full exemption, yeah. They can both move into the replacement property. Dad can take advantage of it, as a matter of fact. What if I have co-tenants or I have joint tenancy, tenants in common on a property, and we all sell this property and we buy a replacement property, just as long as one of the individuals who is one of the tenants in common, for example, is 55 years of age at the time they sell and occupy the property, not all of them have to occupy it, it's still available.
But only one of them can take advantage of it.
Well, realistically, yes, only one, but you could have, I'm 55 and then everybody else is 20.
Right.
Right, we're all entitled. We buy a replacement property because I'm taking advantage of the exemption or applying for it. I'm entitled, I sold it. I met the threshold for 55 years of age and older. We buy a replacement property, even though nobody else is living with me, we can apply for the exemption and we're entitled to that.
It's a married couple,
Yeah.
and one person is applying for the exemption. Are they applying only under their name or are they for the title of the house?
The individual who's entitled to the exemption,
That individual.
3 times. Correct, 3 times.
It's not multiplied by 2 when there's 2.
Well, I would assume if they're divorced, then if one of the individuals hasn't taken advantage of the exemption, then the other person would be. But when they sell that existing primary residence to transfer the assessed value from the property they own jointly to a replacement property, only one person can take advantage of the exclusion at that time. So theoretically, the other person who didn't get to take advantage of it, they're gonna have to buy another home and then sell and try and roll it forward.
But they don't get the exemption, the second person, only one of the 2 divorcees.
Is going to get, yes, and that's gonna be settled just by an agreement between the parties who's entitled to that exemption. Let's see.
It's okay if it's different county, right? Like they.
Yeah, all 59 counties in California, there's, even if they didn't permit it before under Prop 90, so yeah, there's no stipulation there. So anywhere in the state of California now. So we talked about co-owners, they had to determine by mutual agreement who's entitled to it. What if I live in a multi-unit building? Let's assume there's 2 people on a duplex and we're each occupying one of the units. Are they each entitled to the exemption? Yes, they are. So if they sell that duplex and move on and they each buy their own primary residence, they're entitled to the exemption. And then if people's homes are destroyed by natural disasters, there is no limitation in regards to the exemptions, how many times you can use that, as a matter of fact. And then for married couples, must both spouses be 55 years of age or older? No, only one must be at the time of sale. And we talked about spouses, if they're divorcing, only one is entitled to the exemption, as a matter of fact. And then remember, you must be age 55 at the time you sell the original property to be entitled to apply for the exemption. You have to prove your age? Absolutely. I'm not sure what they're going to require, birth certificate, who knows, but they're going to ask for documentation about that. And then just to answer your question, Gina, also it doesn't matter where the property is located, which county, there's no requirement or no counties that are not permitting it. As a matter of fact, it's a state law. Then what about property tax relief? And this is really one of the biggest questions, I think. There's a lot of details we've gone through. What if the property is not of equal or lesser value? What is equal or lesser value? So we have to define that, as a matter of fact. Equal or lesser value is going to be the full cash value of the original property versus the full cash value of the replacement property. So if I buy a replacement property within 2 years preceding the date of sale of the original property, full cash value is going to typically be the sales price, or what I pay for that replacement property, comparing that to the selling price of the original property. So as long as when I buy a replacement property within 2 years prior to the sale of my original property, and it doesn't exceed 100% of the selling price of the original property, I'm entitled to transfer the assessed value to the replacement property. What happens if I buy a property within year 1 following the sale of my original property? Well, equal or lesser value is equal to 105% of the sales price of the original property. So let's use an example. I buy a home for $500,000. Actually, no, I sell my original property for $500,000, but 2 years before that, I bought a home for $500,000. So we're not exceeding 100%, so I can transfer the full assessed value to the replacement property. If in the year 1 following the sale of my original property, I buy a home for $525,000, just as long as it doesn't exceed 105% of the sales price of my original property, which is $500,000, then I'm entitled to transfer the assessed value without any type of increase in regards to my property taxes. So if I buy a replacement property in year 2, following the sale of my original property, I can buy a home for up to 110% of the selling price of the original property and not incur any additional tax. My assessed value will transfer. So in that example, it would be a purchase price of $550,000. So I sell my original property for $500,000. Within 2 years following that, I buy a replacement property. So as I don't exceed 110% of the selling price of the original property, in my example, it's $550,000, I can just transfer the assessed value without any additional taxes being incurred. So if I buy the replacement property before, it can't exceed 100% of the selling price of the original property. I buy a replacement property in year 1 following the sale of the original property. It can't exceed 105% of the selling price of the original property. In year 2, it can't exceed 110% of the selling price of the original property. And I can then just transfer my assessed value.
So you can buy it before, you can't buy it before.
Yes, you can. That's why you're here today.
Yeah. So you can buy when you're 53 and sell your primary home at 55?
Yes.
Oh,
Yes, you can, as long as you're 55 when you're selling. Yes, tell us.
That was a good
So
question, actually.
you
That's a
can
good
buy
question.
Replacement home at 53, as long as you sell your primary residence by 55, and it's 110% of.
That 110% applies to 2 years later buying a replacement
2
property,
years.
Yeah, after.
Later, not before.
not
So
before.
it'd be 100%.
Yeah, yeah.
So, but anyway, otherwise it's just the difference of, the sale price minus the whatever.
Yes, yes. So equal or lesser value, you buy the replacement property first, can't exceed the selling price of the original property. Does that make sense, Gina? So I bought a home 2 years ago for $500,000.
We just talked about today. I sold a house today.
All right, you sold a house, all right, go
I
ahead.
sold a house today at $500,000.
That's my original property, right?
My original, I'm living in this property.
Uh-huh,
Then I'm gonna buy a replacement property. Within the next 2 years, you're saying I can buy up to $550,000
correct.
and transfer my original property tax base from this house to this house.
Very good.
Is that right?
That's right, yeah.
Is there any, like I buy a $500,000 house and then I sell my $500,000 house, my tax base, then I move into a $2 million tax. I can transfer the whole thing over, or is that when the one?
No, you're gonna have an increase in regards to what your assessed value is, but that's a good question. I'll talk about that. My number is gonna be smaller than yours.
So if you sell before in hopes that you're gonna sell 2 years later at the same price, the 100%
But
price.
if you sell it before.
I mean, if you buy before, 2
Uh-huh.
years prior, to selling the home, you better hope that the market doesn't crash, right? Because what happens then?
If it crashes?
Yeah, like if you buy something for 500 and then you try to sell for 500.
Then you're going to, if you don't buy a home, in your example, if you bought a home 2 years ago for 500,000 and now you sell your original property for 400,000, you're gonna lose the exemption. It hasn't been that often I'd say going back to the early 90s when the market crashed.
Yeah.
If you want to call it that in terms of a reduction in values of the property.
So even $1,000 less than what you should be selling it for, you lose the exemption.
Yes, and so obviously what can happen, people can play games, right? But John was talking about the assessed value. Just because usually the full cash value is equal to the sales price, that's not necessarily the case. So that's going to be the dilemma. How far do you push it, as a matter of fact, for the assessor to make a determination that what you paid is below market? So, and now what's very common, and actually on the PCOR, preliminary change of ownership report, if a buyer pays real estate commissions, before it wasn't very common, it's probably becoming more common now, as a matter of fact. They have an obligation to report that on the preliminary change of ownership report. And do they intentionally negotiate a purchase price and intentionally to take advantage of the exemption, say, I'm going to pay the commissions? Will the assessor look at that and say, you did that intentionally so you can take advantage of the exemption? You're paying those commissions even though we know what you're doing. I don't know where that's going to go, as a matter of fact. Before, it wasn't very common. But you do have an obligation as a buyer to report the fact that you paid the buyer's agent's commissions on preliminary change of ownership
So, like,
report.
maybe we could just twist around the numbers of the commission.
Yeah, you can twist it on the numbers, right?
Wait, like a buyer, you have that obligation?
You do. That's a specific question on page 2 of the PCOR. Did you pay the buyer's agent's commissions? Theoretically, the assessor is going to look at that and say, if you paid that, then the value of the house is probably that much greater. And then does that mean you've exceeded the threshold because you paid those commissions? I don't know what the answer is. I think it's so new in regards to what's happening. Yeah. Just another consideration. Let's see. Anybody want to tell me what taxable value of a property is?
Taxable value?
What's the taxable value? Define that for me.
Assessable value?
I'm sorry, what?
The land assessable value.
Very good. That's really what it is. It's the original purchase price limited by Prop 13, right? So you can increase property. The assessor can increase the value of the property by more than 2% every single year. So that's what the taxable value is. So that's what we're talking about, transferring to the replacement property. That's what the taxable value is. So I think somehow I skipped over your question, Gina. I don't know if I'm quite there in my presentation. Okay, so Gina had an example in regards to selling a home for 500,000, buying a home. I'm going to use my simple numbers, Gina. So let's assume the original property that I'm selling has a taxable value. All right, so original purchase price plus Prop 13, 2% annual increase of 500,000, and the original property now sells for 900,000. I buy a replacement property for $1 million. So I can transfer the assessed value from the $500,000 home to the replacement property, but now I'm going to have an increase in regards to what my assessed value is going to be. And that's going to be the difference between I'm paying for the replacement property of $1 million versus the selling price of the original property of 900,000. So in that example, it'd be 500,000 plus $1 million minus $900,000. So my assessed value would be $600,000. So I can transfer the assessed value from a relinquished property to the replacement property. And then if I pay more for the replacement property versus the selling price of the original or relinquished property, I'm going to add that difference. So I sold for 900, I bought for $1 million. I'm going to take that difference of 100,000 and add that to the assessed value of $500,000 on a property I just sold. I'll be paying taxes on $600,000.
Please repeat that.
Yes, I will.
So the original purchase price back when you bought it was 500,000. And you're selling it for 900,000.
So there's an equity.
So whatever the assessed value is, I bought it for 500,000. Let's assume, we're just gonna assume
Yeah.
that today's assessed value is, right? I sold that 500, the property has an assessed value for 900,000. I bought a home for $1 million. So we can all agree that I paid $100,000 more than what I sold my original property for, correct? I'm gonna add that $100,000 to the assessed value of the property that I just sold.
Which is fine.
Yes, so that means a total assessed value of $600,000.
The $5,000, the $500,000 is the price you bought that property.
No, I'm saying that's my assessed value today. I bought it, let's just assume the assessor is taxing me on a value of $500,000.
So it means that if I bought a house for 500,000 and I sold it for 1 million, and then I bought it for 1.3. So the assets value would be 800,000.
Yes, that's exactly what you'd be paying taxes on. Yes, exactly. So whatever the assessed value of the original or relinquished property is, add that to the difference between the purchase price of the replacement property, subtract from that the selling price of the relinquished property. That's going to be my assessed value.
And if I don't claim it now, I have 2 years to do so.
You have 3 years from date of sale of the property, the original property, to claim the exemption.
So the second year would be 105.
Now, that's a different story, right? That's
That's another chapter.
now, so the 105%, that gets back to the term of equal or lesser value. Because if I buy a home of equal or lesser value to the home I'm selling, I can just transfer my assessed value to the replacement property. So we can all agree in our example, let's just assume I sold my property, I bought today, I bought a property for 500,000. And then in a year from now, and I'm not occupying that, I'm still occupying this original property. In a year from now, I sold mine for 500,000 because I didn't exceed that $500,000 selling price. I can transfer my $500,000 assessed value, whatever that is, to the property I bought today. That's equal or lesser value, right? As long as the purchase price of the replacement property doesn't
So
exceed
what
the
is
selling price.
benefit of that? Because if it's less. So what?
Well, usually what I've witnessed, the property you're selling, you probably bought a long time ago, and you're paying property taxes on $100,000 value.
But if I bought it 2 years ago
Huh?
and it didn't appreciate that much and I bought it for 500 and then I'm selling it for 400, so it really doesn't.
Well, you're not giving up anything, are you? Right? But most likely, if you bought a home 2 years ago, the assessed value is going to be lower than what you're selling it for. That's usually the case.
Yeah, so we are really thinking about the 2% saving that we every year that they might increase. it.
Oh, no, I think the 2% just limits how much you're paying taxes on,
Right,
but
if we are going back,
Hmm?
we eliminate that. We are trying to save on an original, right?
well, I think what we're saying is that we purchased a home 5 years ago for $500,000. It's probably worth $1 million today. But you're paying taxes on maybe $550,000.
So
And
the maximum they can increase your taxes is 2%.
yes, under Prop 13 in terms of determining the assessed value, right? So it's right, they'll assess it based upon the original purchase price, and then they can't increase the assessed value by more than 2% every year. But yet we've witnessed properties going up by 10 or 15% annually. So if you think about the amount of money you're saving, theoretically, if you transfer that assessed value to replacement property, it's pretty substantial.
My question is regarding the people that they were married, now they are divorced, or
Yeah.
they are partner, now they are. Is that
you know, I heard that the assessor told them they only, one of them only.
That's correct. If a married couple is getting a divorce, only one of them, if they're both entitled to the exemption, can transfer that exemption to a replacement property.
Okay, so if like a partner, they are two, and they buy a house for 1 million, and they sell it for 2 million. So is it like the proceed for each one of them, it's what the net amount they get, or it's?
No, only one person out of your example would be entitled to take advantage of the exemption on a replacement property. And it's based upon the gross selling price.
Yes, but again, each one of us, we put 500,000,
Uh-huh.
and we bought the house for 1 million.
Mm.
Now we are selling it for 2 million. So it's really it's really like each one of us, we get a 1 million, not the 2 million, but
It's only one single family property though.
so they go based on a 2 million, not the.
Correct.
Oh, so it won't help them.
Well, why not?
One of them.
It's gonna help one of them unless they stay together, it'll help both of them, but if they're separating. If they're separating and when they decide that one person can take advantage of that exemption, that's gonna benefit the next person. Because they can transfer their $1 million assessed value to the replacement property of 2 million.
So that's my question. They go based on a 1 million, not the 2 million.
1 million, assuming $1 million was the original purchase price. That's what the property is being assessed at. Let's forget about the 2%. Let's just assume it's being assessed at $1 million. And that same property sells for 2 million. If they buy a replacement property for $2 million,
No, they don't. They buy it for one of them buy a house for 1.3.
okay, then they're not gonna have any increase in their property taxes. What did they sell the $1 million property for?
I'm sorry.
So you said they bought a home for $1 million. What did they sell it for?
2 million.
Okay, so if they buy a house for $1.3 million, they're not gonna have any additional assessment applied. They're gonna be paying tax on $1 million still.
I see.
They can buy a home up to $2 million because they sold the original property 2 million and not have any additional increased assessment.
So it's really based, they don't divide it how much. each
No, there's no
people
division.
based
There's no
on that.
division.
So they bought it for 1 million, they buy it for 1.3.
Mhm.
But they sold it for 2, so it doesn't help them there.
What do you mean they're not paying taxes on $300,000?
Right, that's what I am saying.
Yeah, so that's still 3,000 to who knows, or $1,000 a year. That's a lot, right? Yeah.
Thank you.
So when does the actual exemption occur? It's going to be, you can apply it to the replacement property the later of the date the original property is sold or the date the replacement dwelling is purchased. But remember, I could buy a replacement property before and I can't transfer my assessed value to the replacement property till I sell the original property and occupy the replacement property. Any questions on it? And what about new construction? Well, you still have the same time frame. So if there's new construction and assuming the value of the replacement property added together with that, the market value improvements doesn't exceed the 100%, 105%, 110%. There's no additional assessment, but it has to happen within a 2-year time frame. You don't have to take advantage of the exemption, by the way.
I imagine that getting that tax assessment on a new home, like paying taxes on your $500,000 home. That's just amazing.
Yeah, so let's assume I buy a replacement property. I actually move into that replacement property. I'm calling that my primary residence, and I haven't sold the original property yet. Well, the taxes on the replacement property are going to be whatever it is until you sell the original property. And then theoretically, I don't know if we've ever gotten money back from the government, you can then file for the exemption and go back and recover that money that you've overpaid. So that's a possibility. And then can I rescind my application for an exemption? Well, that's a good question. Prop 60 and Prop 90 allowed it. Prop 19 has no language in there, so it's probably something that could be contested. Maybe somebody decided they wanted to rescind their application because they found another property that was more beneficial to them. And then let's see, transfers between parents and between grandparents and children. So you can actually transfer property to between not siblings. Siblings are excluded, by the way, from children to grandparents, grandparents to children, or parents to children. But the transfer for any type of exemption between grandchildren and grandparents can only be available to you if the parents are deceased. Does that make sense? So we have level 3, which is the grandparents, level 2, which is the parents, level 1, which is the children. So a transfer between children and grandparents is only available if the parents themselves are deceased. Sounds morbid, huh? So keep that in mind. And let's see, in regards to, and remember, to take advantage of any intergenerational transfer, which is very limited as a matter of fact, let's assume it's parents to child, it must be the parent's primary residence and the child must occupy the property as their primary residence. As soon as that child moves out, they lose the exemption. Period.
They can't.
Now, I'd say they just lose it. At that point in time, at the time it's no longer their primary residence, they lose the exemption. So they must occupy it as their primary residence. So let's assume mom and dad die and they transfer the property to the child. Well, the child has 1 year to make that property their primary residence to take advantage of the exemption. Just as long as if they're all on title, one of those children occupies the property, the exemption is available to them. And what if the person that's occupying it decides to move out? Well, one of the other children that's on title can actually move in and the exemption would continue.
The exemption
That's good.
that you're referring to is a tax. What exemption you talking?
It's just simply for property taxes. That's all we're talking about. We're not talking about any type of capital
So
gains
you're
or anything
talking
else.
about the exemption of the taxes that the parents they were paying before.
Yes,
It
yes,
can be transferred. To
yes.
the children.
But no more, the exemption is no more than $1 million in excess of the original purchase price. So the benefit is really not that great in today's world. They've owned it for 20 years and they're in Crystal Cove or something like that. In essence, that house, if they bought it for $3 million and now it's valued at $10 million, well, the child's going to pay tax on $9 million. They're going to get $1 million benefit in regards to a reduction of the assessed value.
So what we're doing, if the parents pass away, if one child decides within 1 year to make that property their homestead, the original property tax exemption transfers to that next generation.
Yeah, but the limitation is equal to, you're going to get a $1 million benefit at most. So if we bought it for 3 and that house is worth 4 million, they're not going to pay any additional taxes. But if they bought it the parents bought it, the original purchase price was 3, and now today's value is 10 million, they're going to pay property taxes on 9 million. They're going to get a $1 million benefit.
And this is as long as the child lives there.
They
So-
must live there, otherwise they move out. It's no longer the primary residence. They lose the benefit.
Okay, so if just 1 year and they move it, rent it, they will do so.
They will lose it. Yeah, that's pretty harsh. Think about it. Let's see.
So if the child moves out of it after like 2 years,
Huh?
turns it into a rental property,
Then it's going to be reassessed at its full value.
and the assessor would know because they probably bought another property, made that their home.
And they're probably going to claim the exemption, the $7,000 homeowner exemption. Yeah.
So if there have a multiple children, and then is only one child can use the exemption as a married property divorce situation, or every kid if they live there?
Just as long as one of the children who is on title lives in the property, the exemption is available. But if none of the children who are entitled to the exemption occupy the property as their primary residence, they will lose the exemption. That make sense?
Is the only way for the county assessor to know that the children aren't on the property because of the whole section, the homestead exemption?
Well, here's another thought, that it's possible that now that's converted to a rental property and it's gonna show up on that person's tax return or somebody's tax return.
And they are finding out, Rich. I've been getting calls.
There we go. People have tried Gina's approach. Creatively.
Buy something, or they rent something and have a new address on their tax return, because the state looks at all of it now under Prop 19.
So they're sharing information.
Correct, because all the counties are participating, so they have a statewide database.
Oh, there you go.
And against our advice, they still go ahead and do it, and they say, oh, they won't find out, but I've had 2 calls this year saying that they got the exemption taken away.
So yeah, and I guess if you fight it, it's probably fraudulent anyways. It's really, you know.
My question is,
You got a
you
question?
know, when they find out,
Well, yeah.
for instance,
Uh-huh.
they find out now, but this transfer was known 5 years ago.
Uh-huh.
And the last 5 years wasn't the person living there. Would they get penalized?
Oh
for
my
the
God,
last
yes.
5 years?
They're gonna recover everything and then probably penalties and fees too for that 5-year time frame. That's what I would think would happen. Yeah. That's, Mary, you seem to have more information on that than I do, but that's exactly what, they're gonna recover everything in between. Plus, the 2% increase annual in Prop 13 if values have gone up too, so it's gonna be reassessed every single year.
I have another question.
You do?
What if the parents pass away and a child takes over the property, legitimately living in the property, or rents out 2 to 3 other rooms? I'm just talking out loud here. Claims the income on the taxes legitimately, right?
I think it's because it's her primary residence, they're not violating the guidelines and it's not subject to reassessment. That would be my thought.
They're not violating.
I don't think so. I think that would be a good argument, Gina. So that's your claim now. I'm still living there. All right, well. Realtors are creative.
I think she's covered every possible scenario.
I think she does. I'm not surprised.
Yes.
Oh, God. All right, we're hard to believe we're almost done, I'd say. And once again, transfers between siblings, there's no exemption, by the way. It can go back and forth between children and grandchildren, or excuse me, children and grandparents, assuming the parents are deceased. Doesn't matter either way, from children, grandchildren to grandparents, or grandparents to grandchildren. And then legal entities, what if I buy a legal entity that owns real estate? Well, tough luck, you're not entitled to the exemption. And then let's see. Almost done. Just a couple things. We talked about spouses or maybe former spouses. Only one of the former spouses is entitled to use the exemption, assuming they meet the requirements. And then also remember when this is just some basic exemptions. If you transfer a property to or into a revocable trust or back out of it, assuming the same proportional interest, there is going to be no reassessment. Same thing if you transfer an interest from an individual to an LLC or something of that nature, there's not going to be a reassessment, assuming the proportional interest is the same.
If somebody would be added to the title.
That's a sale.
So, but the person is there too. It's like my son, and I'm giving this as a gift to my son, or just even if not a gift because he's on a loan, he needs to be on a title.
you're not entitled to the exemption if you're, in a sense, I'm gonna use your term, gifting or adding him to title without consideration. The exemption is only available if it's a bona fide sale and there's consideration being given for the property. So giving a property to your son or giving an interest in the property to your son will preclude you from maintaining that exemption. So his portion would be reassessed. So if he has you give him 50% ownership on the property, his 50% ownership on that property is going to be reassessed at today's market value, unless you sell it for a reasonable price.
What if you remove someone from title?
If you remove someone from title,
Does it get reassessed? Like.
well, theoretically, it could be a sale, or is it spouses on title?
Okay, so I have a home in Santa Ana. It's my husband, myself, and my dad. And so let's say, for example, I want to remove myself and my husband because my dad's over 55. Would that property get reassessed?
Well, first of all, that's I think a couple of different things. It's probably going to be a gift if you're just removing yourself from title. And this is in a separate state?
No, it's here.
Oh, it's here.
Santa Ana.
Awesome. In the state of Santa, well, you could show it for no consideration. So you can do that on a PCOR.
Does he live in the property?
He does.
So on that, you can almost do like the parent to child and it wouldn't be, or child to parent and it wouldn't be reassessed.
Our taxes are like $2,000. So I don't.
Yeah, you don't want to lose that benefit, do you? I can't blame you.
Well, if he sells it, he gets the exemption.
Yeah,
Live there,
yeah, well, who lives there?
my father.
He actually lives there.
And if you're giving it to him, I believe he'd be okay.
Well,
That
she
you'd
just
want-
said that you're gonna be reassessed.
I will.
Yes. Yes.
So any vesting change.
Because we're basically like, it's a common tenant there, like, so it's a third each.
See, it's no longer a transfer to the same proportional interest. If all three of you transferred it to your trusts and the proportional interests were alike, there won't be any reassessment. But now the proportional interest in the property changes, so they will reassess it. At least they're going to give you a 2/3 increase in reassessment because I'm assuming you each own 1/3.
Or he can sell it, they can sell it, and then he can take advantage of the exemption and then keep that. Right?
No, why would you not?
Because you said only one person's,
There's 3 people on title, 2
Right.
people that don't occupy the property.
right,
They could sell the property.
But then
Possibly.
only his percent would be.
no,
No.
no, he
no,
would
the
take the
other-
whole
The only
exemption
one
with
that's
them.
55.
He would take the whole exemption with them, right, for the replacement property,
This is 55.
for the,
If you're going to do that, I would call the county.
The interest has to remain the same. That's the point. They can't just transfer their, and if all 3 of them, it doesn't matter.
They have to go all buy a house again.
Yes, they can all buy a replacement property together because he is 55 years of age or older at the time he sells his property. He buys a replacement property, they can transfer the assessed value. But no, other than your example, that assessment, that's not going to benefit.
so in the example with the divorce
Yeah,
couple, one takes the exemption, the other one doesn't.
Yeah.
How does that work? But it doesn't work. It's
doesn't
only for
work with
marriage,
the
for,
Are you talking about
Or
the
married couple?
gain or are you talking about the?
No, we're just talking about property.
Property tax.
Well, I'm not sure that this is my understanding of the guidelines,
Yeah.
right? 3 are on title, he occupies the property, just as long as the proportional interest of the replacement property remains the same, you can transfer the assessed value. But they're not talking about keeping the same proportional interest, even though it's the same property. They're granting their interest in the property to him completely. So at minimum, he's going to be reassessed, in my opinion, at least on 2/3 of the value of the property.
But if we put it in a trust, you said something about a trust.
Well, I'm just suggesting if the transfer into a revocable trust, the proportionality of the ownership interest doesn't change, there won't be any reassessment, but that would mean you and your husband would transfer your proportional interest into your own trust. Likewise, he would transfer his interest into his own trust, and that would not create a reassessment.
So create 2 trusts, there's no reassessment in this situation.
Yeah, but it doesn't, she wants to get off a title. That's her goal here. So that's the problem she faces.
Why
and
would,
not trigger. any property
Yeah,
taxes.
yeah. Yeah,
Yes.
I don't want it to be.
so when you give a parent to child, if the child's living in it, it's not it's reassessed, but then you can take the exemption and take it at their value for property taxes, like if you're giving it.
If
I
they're living in
believe
the
it works
property.
the same way from a child to a parent. Although it's reassessed, they can look at it and you can take the exemption and take their tax value since the dad is still living in the property. So you might,
I don't think so.
okay,
I don't think so.
and
That's
it might
not-
only be half, it might only be your half and not your
Well,
husband's
that's
half.
for you to ask, that's it.
No,
He gets into my pocket just as deep as yours.
Yeah.
yeah. And it might only, if that's the case, it would only be your half, not your husband's, because it would be child to parent. And that's where it gets,
I think you're gonna have a 2/3 reassessment. That's really what I think is gonna happen.
If I bought a house with my son on title, I'd say I'm over 55 and my son isn't, right? But we're on title together. I turn 55 and we sell the property together. And I buy another property.
Are you occupying the property as your primary residence? Then you're not entitled to the exemption.
But what if my son?
He's not 55.
You, the
Okay.
person who's taking the exemption, must be owning and occupying at least a portion of our property as your primary residence.
If he was 55, that'd be different, right?
What?
If he was 55.
If he was,
that'd be
but he's not.
Yeah,
He's
no, but
what,
if he was.
19? Long way to go.
Good day.
I'm not sure why would you do that anyways?
Just make it out.
Just being creative.
Okay, now what's your goal here? I guess that's really my question.
Does
Okay,
she have a second primary?
can she have a sec? No. That was a simple one.
My goal was prices for homes going up.
Uh-huh. And then,
Buy now.
And I'm trying to figure out how to buy sooner than later for the next generation.
I see.
Yeah.
And I'm trying to find a creative way where that starter house may not be the one they want to live in
Mhm.
forever, right? But they could take potential tax advantage.
I see.
That's what I'm thinking.
Okay. Well, I think the best thing to do is for you to die and just give him everything.
If you keep asking those kind of questions, that could happen.
Yeah.
I wasn't
We would all be very unhappy, I can assure you. Gina. Okay, any other questions? No, perfect timing. Okay. Excluding Shweta. I think everybody that's here turned their cards in, right? Should we give her an exception? Oh, no. Oh, no, we have another person who wants to violate the rule.
Rich, I'm gonna let